So the S&P 500 is still consolidating its recent pop to new all-time highs. There is a lot going on underneath the surface. So today we're going to cover a number of topics, starting with the S&P 500, retail, consumer discretionary, equal weight consumer discretionary, semiconductors, energy, and gold. So let's start with the S&P 500 and the live patterns. And again, this is the pattern grid that we show our CappThesis clients every morning in our flagship piece opening look. And so over the last few days, it's been a very rare occurrence because we had 3 live bullish patterns simultaneously. And as we can tell coming into today's session, actually below the most recent breakout zone of this pennant, not by much, but obviously something to consider. And so going through all of them, starting with the closest price target, this was the cup and handle pattern that we have been tracking for a long time through June and July. Finally got the breakout. Again, that very strong 4-day move produced this 7,925 upside target. Next, as the advance continued, this whole trading box was eventually broken out of as well. And adding all of this together, the height of this pattern gives us an upside target of 8,005. And most recently, again, with the consolidation starting, as after the first few days of August, we first looked at this as a potential flag pattern. Then it looked like a pennant, which we got a breakout from late last week, and now have been pulling back on Monday and again so far on Tuesday, August 18th. So needless to say, when we have a small pattern like this, the tendency for it to be negated is high, or at least tested, which it's doing right now. And with this one being so small, you wouldn't be surprised at all to eventually see it morph into something more substantial. Looking at it from this angle, this could just be a trading channel. It could be turned into a much bigger flag pattern, or it could eventually become a cup and handle pattern, inverse head and shoulders pattern, whatever it is. This is just the beginning stages of the next phase. Again, after one of the biggest 4-day moves we've seen in quite some time. And so in terms of the daily price action, at the tables we track the important data points for every trading day here. A few things have changed recently. Number one, the closes just haven't been that good, right? We've had now 6 closes below the intraday midpoint in the last 9 trading days. That's not a good pace, and it just shows that there's more distribution, or at least not a lot of accelerated buying efforts during the trading day. Not too surprising, again, coming out of this 5-day period, which showed 4 1% moves, in particular 3 gains of at least 1.5% in 4 days as July ended and August began. So seeing a lot of non-movement overall, not surprising. And so from a breadth perspective, again, not too high, not too low, right? Just kind of marginally negative, marginally positive. And the only thing that changed recently was just yesterday on Monday, August 17th, when there was just 26% of S&P advancing stocks. And so as this, of course, transpires, the concern is eventually that could lead into more of the same. So far, it is not. And we've seen aberrations before, right? The last time we saw sub 30% was back here on July 17th, and didn't come close to that again until that 26% from yesterday. So looking more closely at breadth, right? This is what the most recent negative breadth session did to the cumulative advanced decline line. Not much, just pull it off of its all-time highs, as the S&P 500 has been pulling back off of its own highs after that very strong push that created the breakouts from those 2 bullish patterns we've been looking at. And so we've seen this before, though. Very strong breadth at the beginning, February, right, was keeping the market afloat, but momentum was slipping. And eventually, when the bottom fell out of that advanced decline line, that's when things really started to fall through the end of March. We saw it again in the middle of April. Obviously, this didn't matter for the S&P back then because why? SMH was ripping higher. XLK was ripping higher at just historic clips, as we know, and as we reviewed in the past. That semiconductor SMH ETF was up 70% in April and May, which is one of the biggest 2-month advances in its history, with the only one being bigger going back to January and February 2000. And so again, just one bad breath day does not make a trend. It could start one. We've seen it in the past, just over the last few months. We also have an impending MACD sell signal. Now, we talked about this before, and we think that these signals are actually helpful no matter if they play out or not. Of all of the 22 MACD sell signals we've seen since October of 2024, just 4 have led to meaningful downside. So only 4 were successful across all of them. This one being the 22nd one, of course. And so what does that mean? All of the blue lines indicate times when all we got were whipsaws, meaning that we did not see meaningful downside. The sell signals failed, but it did tell us that what? The uptrend was strong. Now, there wasn't without pulling back at all, but the bids were there anytime a dip happened. And so right now, the last time we had a successful MACD sell signal was in February, again, as things started to deteriorate after the advanced decline line had topped soon thereafter. So from that point, there's only been 2 of them before this one. Of course, just when things started to fade just a bit from the really strong, consistent, undeterred uptrend that began in late March. And so, of course, leading to some pullbacks, but nothing too serious at all. So this will give us another indication of how things are going. Now, remember, it goes beyond just momentum. When things start to unravel like this, we'll also see bullish patterns fail. So those are going to be watched closely along with this, of course. In addition, we're looking at, we pay close attention to the DeMark signals as well. One of them that just happened is called the setup 9. And so on this chart in green, we can see that sometimes occurs before the more popular 13s pop up. So the last time we had a sell 13 after a big rally was back in May, and didn't really lead to too much, but eventually the ensuing advance did pull back before the next bid returned. And so it did a very good job of marking a trading low when we had a setup 9 buy signal. Now on the reverse, we got that setup 9 in the middle of last week. And again, even though the S&P made an all-time high right after that, there has been some consolidation after that point. So again, looking at all this in its entirety, we have potential small bullish pattern that could be negated for the S&P 500 right now. We have potential MACD sell signal in place, as well as a setup 9 from a DeMark perspective. So all those together tells us that things have gotten short-term exhausted, and we may be at least due for more consolidation before another real bid emerges. So if you're enjoying this content, again, I urge you to check out our free Substack newsletter, Cap Notes, where we share multiple pieces of content per week. Just today, talking about S&P breadth and momentum, where we go into more detail about the advanced decline line and momentum pulling back. Also, in this last piece that was from Sunday, the 5 best charts of last week, talk about the key areas that we were discussing throughout the week, as well as profiling one particular chart trade idea that just gained 24% before being closed out in 9 trading days. So check that one out. Again, it's capnotes.substack.com. I look forward to seeing you there. So let's turn to retail now, because as we know, the biggest retail companies are reporting earnings starting this week. And so looking at the 3 key retail ETFs, starting with XRT, this one is equally weighted, has about 90 components in it. So along the way, we're talking about how well it did of forming a bullish pattern through the middle or through the beginning of July. Had that breakout, the breakout failed. Another bid returned, a better breakout, that too failed. So now we start the retail earnings season back below this key area. So this 89 zone is really the line that it has to get back above, right? It was resistance, then became support. Now it's an area that really is giving fits to both buyers and sellers. And so seeing how well XRT can do in regards to this level is going to be very important as these earnings reports go through. Now, turning to the XLY consumer discretionary ETF, as we know, is controlled by Amazon and Tesla, which have been moving in a volatile fashion and in opposite directions of each other over the last number of months, and this is how you get this really jagged movement, right? This is really just a mess. You can't make much of it at all, right? Straight up, straight down, straight up, a lot of back and forth movement right around the 200-day moving average. Another big decline, bounce, and another rally back to the trend line. So at this point, we just need to see better price action, more trustworthy movement, less volatility, fewer whipsaws, so forth and so on. And so what does that tell us? It tells us that Amazon and Tesla need to find themselves in more than just big rallies that get stopped immediately. We need to see real bullish patterns form, consolidations taken advantage of to the upside. Eventually, this could lead itself to a trustworthy breakout. Now, from a equal weight perspective, doesn't look that much better, right? This goes all the way back to just about the last time we had the earnings season in the summer of 2025. Made a new high, again, broke out from a huge pattern after the comeback, couldn't hold it, which has a lot of volatility all the way back. And the only thing that we can determine from here is that traders have been willing to sell after strong moves to resistance and willing to buy after big downturns back to support. So with us coming off of almost testing those highs, there really isn't much in the way to key off of right now. Kind of no man's land. And again, that's okay as long as you recognize the fact that this has really just been a trading vehicle and nothing else up to this point. So turning to the SMH Semiconductors ETF, as we know, it's been a pattern battle for quite some time. Now let's first look at the bullish version, right? This is the potential inverse head and shoulders pattern that has been taking place over the last number of weeks, where we finally saw a bid come in at the end of July, had a pretty good effort up to this point. But as we were talking about, this area just around 600 includes the neckline of the pattern and also the flat 50-day moving average. And so far, SMH has not been able to push above it, making it obviously resist. As we can see from these individual daily bars as well, closing well has been very inconsistent. Good close, bad close. Midpoint, good close, bad close. Midpoint close, bad close, bad close, pretty good close, another bad close. And so even though the SMH has been rallying overall, we just haven't had that burst of momentum like we saw all the way through here. You can see how many times not only did the SMH ETF move higher, but how many times it closed very well, almost near its highs every time until we saw the first chink in the armor in the middle of June. And from that point, it really hasn't been that good of momentum gauge, of course, as it was. And that's one reason why the S&P spent so much time hovering underneath its own highs without being able to break out. So with that being the case, on the bearish side, this continues to be viable as well. Now it's clear the SMH now has been back above the breakdown zone, right, just above the 560, 570 area, but it hasn't quite gotten back to this right shoulder. And again, from a chart trade perspective, this has been a short on our sheets ever since it broke down a few weeks ago. We typically don't exit shorts just because a security gets back above the breakdown zone. We want to see the structure that provided us with the trading opportunity in the first place completely negated. And a lot of times for a head and shoulders pattern like this, that is that right shoulder. So it's gotten close, but hasn't quite gotten there. And again, that's why getting through the 600 level is so important, because once it does, there could be a burst of momentum that gets us there in quick order. So far, that has yet to be the case. Turning to energy, one of the best charts that we've shown and talked about over the last number of weeks has been energy. In a piece about 2 weeks ago, we noticed that one of the collection of best looking charts came from energy, and we profiled XLE, OIH, XOP, and even the IGE ETF, which has 30% energy as well. And so thought was that if we were to get some sort of bid around here above this flat 50-day moving average, that the right shoulder of a potential inverse head and shoulders pattern could get etched out. Of course, that happened. We now have the upside break, which has produced a pretty substantial 70s RSI reading for XLE now in the middle of Tuesday, August 18th. So it may not quite get to 69 without a pullback, but this is quite clear that is taking advantage of this breakout zone. And we saw something similar in May, only lasted 2 days. So this one is doing better so far up to this point. Let's not forget what all of this is as well, right? This is all of 2026 right here, right? So this whole thing from here is just what is taking place above this huge, more than decades long bullish pattern on log scale that it was able to punch through as 2026 began. So again, if we're looking at this from a very long-term point of view, then we shouldn't concern ourselves with being short-term oversold, understanding that this big bullish pattern is still in play. And lastly, GLD Gold, again, good comeback so far. Remember, all along the way, we're talking about how it is inability to even get back to its 50-day moving average, let alone test it, which it finally did after flatlining for a number of weeks. Finally broke out of this trading box, got to the target, and now is staring right at its 200-day moving average. And of course, the best thing that happens when something bottoms after a long downtrend like this is it creates the potential for a bigger foundation to be formed. And so right now, that looks like this. As of Tuesday so far, hasn't quite gotten through this area. Again, getting close to overbought territory, but just staying around this zone between 390 and say 410 would keep this right shoulder potential in place to eventually have this entire period of price action from June through the middle of August be one large basing formation or bullish inverse head and shoulders pattern, which has an upside target up to 450. So lastly, this is what it looks like on the weekly chart. So the next step, if it were to eventually leverage that bullish pattern, would be to then take advantage and get through all of the weekly moving averages. Done a good job already overtaking the short-term 13-week moving average in green, and then right now getting through the 26-week, which of course is half of a year, and then the 40-week, which is like a 200-day moving average, would be the next step. Because as we know, when that happened at the end of 2023, that really led to the huge move we saw all the way through the beginning of this year. And for that to occur as well, seeing the RSI eventually get back above this 50 zone and stay above it could then put it back in the driver's seat in terms of bids controlling or buyers controlling this uptrend, as opposed to having any of those rallies being sold into like they have been for the last number of months. So that's what we have for today. Don't forget to check out the rest of the videos on this site, and I'll talk to you again soon.